So welcome to this week's Elite webinar. My name is Riz. I am hosting. Chris is unfortunately not hosting the webinars due to his own commitment. And with that said, I completely understand. And he will of course be dearly missed, but he is still, of course, in Elite. He is part of the team. He's just unfortunately unable to meet those requirements and commitments of his personal life, work, and of course the commitments to elite webinars. So with that said, I'm stepping in. Thank you and welcome. Let's kick things off. We have the S&P 500. We're going to continue with a very similar format as we did, you know, before. Not much changes besides, of course, Chris's sultry fantastic radio DJ voice. So although mine may not be as good, please bear with me. All right. With that said, we have the S&P 500 with a massive run the past about a week and a half, really, if you think about it. Just two red days. I would count the 12th, you know, Monday this week. Yeah, it was a red day, closed lower than where we opened, but really it was more of a consolidation kind of day. We had one red day on the previous week, on Wednesday, August 7th, and apart from that, it's just been off to the races. It's like a pure V-shaped rally. Now, did I expect this V-shaped rally? No, I didn't. I didn't. Honestly, I didn't. And I'd be hard pressed to find too many people that did. Like, yeah, I think it dropped fast and furious. I felt like there was more downside to go. I still think in the long term there is more downside. But we know the market doesn't just work in a straight trend line down, right? Otherwise, life would be easy. And we wouldn't even need to do these webinars. But with that said, we've seen this massive big run up, big break above the 5,400 resistance. Um, so that right there was an indication like, whoa, this has legs. This has quite a bit of gas to the tank. Not only that, it broke past the 50-day moving average. It's this light yellow line here. All right. Strong push. Now, I would say the next resistance point we have, and I'm gonna mark this on for you, is 55. So we're right there at that 55, 65, 55, 70 area. Um, Now, just trying to anchor this here, 55, 75. Okay, close enough. I'm going to put the resistance there. Remember, this is not an exact science. All right. I will reiterate that because it really grinds my gears when people are like 55.75 and 55.74.50. It has to touch there and there only and break through in this kind of fashion. No, there's no, this is a multi-trillion dollar industry, like I would say profession. There's trillions of dollars being changed hands every week. There's no individual line that's going to uh, define if a stock or the market will solely be bullish or bearish. Okay, so we need to have that understanding that look, these are a bit subjective. There's a bit of wiggle room. There's a bit of leeway. It's not a precise art. And I don't believe in drawing too many lines. Like people have a lot of lines everywhere. They're fine if you're like a more of a technical trader, short term, and you want levels. But big picture on the SPX, that's where it is. All right. Look at how far we are from all-time highs. Not that far, if you think about it. It's been a tremendous rally, right? If we go from the bottom of this to now, in about, let's say, 9 days, 9 trading days, all right, which is 11 days so far. Uh, we've had a 7.5% run up. Like that is that's not normal. So one thing that I will share with you, and a lot of people on talking heads on Wall Street, MSNBC, CNBC, Bloomberg, one thing they won't tell you is when you see large moves like this, when you see large drops, you know, sorry, one sec. When you see large drops happen, like we had at the start or middle of July. What's going on here? Jesus. It's right. When you have large drops like we did at the mid-July, it's about 9.5% of a drop. I couldn't get it right because of that line there, resistance line, but about a 9.5% drop from the highs. And then from that, you have a 7.5% recovery, all within a span of roughly less than a month, about a month, less than a month of trading days, but a month. That's a lot of volatility. Okay, we've got a lot of volatility, and when you have more volatility equals potential downside, especially as we head into September, which ding 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 is potentially very likely going to be the first rate cut um, since like 2020, right? Because obviously we've been in a hiking cycle the past 2 years and quite a bit of aggressive hiking cycle. All right. So let's move on. Hopefully that gives you a bit of an idea of the SPX. Here we are with the sectors. Again, colors look a little bit different. Chart looks a little bit different. Bear with me. I'm going to actually, I adjusted all this, but it's looking a little bit suboptimal. So I'm going to change this here. Bear with me, okay? Just to make it a little bit easier. We don't need too many of those white grid lines, or maybe I'm just picky. I don't know. I'm OCD, so maybe this helps a little bit. So I'm going to go year to date. Here we are. Uh, you could see the top left-hand side, as usual, the sectors. Take a look at communications leading, right? SPY here, the red line, a little bit harder to see, I know. I could make it a little bit bigger, but my worry is I didn't want to obscure the others. But here we have big line here in the red. Um, for some reason, I couldn't get the shading to happen. But look, every sector is above the zero line. For those that have been paying attention and watching the webinars religiously, um, and you know, have been tracking the sectors, will know that there's a quite a period of time where we had couple sectors in the red, right below the zero line, right? If we go back here, right, the zero line is changing, but look, we had XLY in the zero line, below the zero line, middle of August, right? If we go further back, oops, right, we had utilities, right? As we go further back into start of 2024, look at that. Start of 2024, we had utilities and energy below the zero line as well. So ultimately, it's it's quite bullish. What's happened is we've had other sectors. We've had things like real estate, healthcare, communications, and not communications, but just like staples and consumer discretionaries come back up, right? And you can see now communications is leading the way with tech following, right? Both similar. The reason we have communications leading is, you got the Apples in there and stuff, right? That's the thing. I would say that XLC was kind of a little bit of a hybrid of tech, whereas tech is complete, tech names, big tech names that you know. Um, but that's why communications is up there. I don't want anyone to mistake communications for being like, oh, it's like the telecom companies. It's not obviously it's not like Verizon and T-Mobile, like not that kind of communications, right? So you could see both leading the S&P 500, but right now SPX about 17.5% year to date. It's very strong year compared to um, previous years. Obviously, 2022 was quite a bit of a depressing year. Even last year, we had a pretty good positive run last year, and that this continues further. Um, Not much to glean from these sectors this week, besides the fact that they've effectively recovered quite a bit from the drop, right? What's interesting is look at utilities. Huge comeback. Why? Well, I've mentioned it many times before, and I'll reiterate again. We've seen that in a rising rate environment or a higher interest rate environment, that we see other income-based I don't want to say income based, but like more stable, slower moving, dividend based companies underperform. Why? Because there's still risk when you invest in those companies, right? You're an investor. It's not a guaranteed thing. They could cut their dividend, they could price could drop, they could underperform on their earnings. So when you compare that to the risk-free rate of the sovereign debt, the good old treasury bill or the cash savings rate, because it's been high, relatively speaking, compared to the last 15 years, where if you put money in T-bills, like you're getting nothing. You weren't even meeting inflation. If you're putting money in a savings account or even a high yield savings account, it was maybe offsetting like half of inflation, maybe just covering inflation. You weren't making anything by keeping it in there. Obviously, that's not been the case the past year and a half, 2 years, right? So when that happens, you have the, more low beta income slash dividend based companies underperform. But that's made a comeback. Why? Because the market is forward looking. The market is essentially pricing in rate cuts. And as a result, those utility companies have been going up. All right. And you can see that strongly here. Moving on to crude oil. Look at crude oil. I don't have any of the trend lines on. Again, I'm not too big on trend lines. I can draw them for you guys if you want. Um, but here we are, right? We got like a flag going on here if you really want to call it that, right? I know it might not be perfect for all the chartists out there, but you got this kind of bull flag going on here, right? Period of consolidation. In my opinion, this is kind of the sweet spot for oil. We're continuing to stay here, even with um, the geopolitical, stuff that's been going on the past couple of years, especially more recently in the Middle East the past year. But I feel that has either the news cycle has moved on, as it always does, to other pressing matters, aka in this case the U.S. election. Uh, but not only that, I feel like maybe the market's pricing in a potential, ceasefire, potential cooling um the kind of let's say war that's going on in the Middle East. So oil has kind of pulled back a little bit here uh as a result, right? Because it had kind of had a little bit of a recovery um as we head into the end of the year and start of the year, just based on the geopolitical stuff. But overall, you can see it's not bullish by any means. Uh, I think now that inflation's, kind of staying below the 3% level, uh, oil prices are stable. I think a large part of the inflation issues that we had uh, leading into 2022, um, and even a good part of 2022 was uh oil prices, right? That hit the average consumer quite a bit. And sure, you may not notice like the price of gas at the pump, it's not a 50% drop, but a 40% drop from the highs. You may not notice a 40% drop in gas prices compared to 2022, but you should definitely be paying less than you were back then, right? So something to keep an eye on. I feel 70-50, 70 area, good support area to keep in mind. I'm going to move this down to 70, right, as support. Close enough here. There you go. Yep. Okay, something to keep in mind now, gold. So gold actually hit further all-time highs. You can see this consolidation and then a spike up. This is telling us something once again. This is telling us something, but something very different. This is telling us that institutions, um, sovereign wealth funds, other countries are effectively have been actually not just now, but pretty much the entire year, uh, been long and bullish gold, and it's reflected in the spot price, right? This is the futures contract. It's not an ETF. This is the spot price of gold per ounce, right? So it's broken above $2,500 an ounce, and of course, all-time high at 25.46. So this is giving us a bit of a red flag, so to speak, but the whole market, the whole economy has been like that the entire year. I would say even into half of last year. It's been a mix of signals, red flag, green flag, another red flag, another green flag, and this sort of, I would say, uncertainty has effectively left a lot of people scratching their heads. Whether you've been doing this for a year or 10 or 20 or 50, it's left a lot of people uncertain of what's going on. Like, is there a recession happening? Oh, are we in we're not in a recession? Oh, like shouldn't the market be like, like dropping? No, what? The data is still good? What? Like unemployment is still down or like, it's like a lot of people were confused. A lot of people were like, this makes no sense. And I get it. It's very confusing because sometimes the data doesn't play out as cleanly as it does or has in the past. Okay. Why? Because, well, it's a different economy, different monetary policies, and a lot of them were experimental, and a lot of them were prolonged. And this is what happens when you mess with that. One thing is for certain, though, is bond yields are coming down, right? Not surprising. We've seen them pull back with anticipation of rate cuts coming in. So settling around the 4% mark, right? Uh, we have the in the I would say dark purple line, you have the 10-year, right? You got the teal line with the 30-year, and then you got the let's say bluish purple in the 20-year. Okay, so we're roughly hovering around the 4%, but this is low, right? Compare that to where they were at a high back in 2023 of like 5.2%. Remember, bond yields are kind of what dictate your interest rate. You may be thinking, well, why do I give a shit about bond yields? I don't trade bonds. I don't care about bonds. I don't care about yields. Well, you don't have to care about them, but in a way, they impact your life and they impact the economy as a whole. Your interest on a car loan, defined by treasury yields, bond yields, sorry. Your mortgage rate, defined by bond yields. Your borrowing for a personal loan, line of credit, defined by bond yields. Okay. How how hot an economy is running, whether it's uh, strong, whether it's weakening, whether it's slowing down, predominantly defined by bond yields. And that's why the Fed focuses on interest rates, right? Because interest rates and bond yields go hand in hand. And as a result, that's how you kind of influence the economy, right? And they've been doing it. This has been a practice for uh, many years, I would say 60 plus years, 50 to 60 years in monetary policy, where when the Fed really had a mandate to kind of smooth out the shocks of the economy of the past. US dollar, once again, hovering around the 102. Again, this is the index, right? It's kind of an aggregate of all other major currencies. Um, Contrary to belief, and I know Chris, you should mention this too, the US dollar is not going anywhere, contrary to what everyone on social media and everyone was panicking and, oh, the US dollar is not being used and everyone moving to their own currency and BRICS and this and that. And oh my God, the US dollar and the petrodollar and like everyone is doomed and we're doomed. And oh, it was like, fuck, like, and these like, and the worst part is these are Americans, they're saying it. I'm like, fuck's sake, guys, like, you don't have to be a diehard red, white, and blue patriot, but have some kind of, I don't know, conviction in your own currency to an extent. Like, oh my God, it was just too much. And I'm like, this is very polarized. So yeah, US dollar holding in there. Keep in mind, as I've said before, simple tidbit. Rates come down, bond yields come down. Rates come down, US dollar strength comes down. Okay. Is this drop slight lower, you know, unexpected? Absolutely not. Absolutely not. Um, with that said, we got the economic calendar here. All right. Quite a bit of a packed week, so to speak. We've got building permits, not the biggest thing, consumer sentiment, FOMC minutes from the last meeting, right? That will give us an idea, but I think everyone kind of knows what's the skinny with that one, what we're heading into in September. We have Powell speaking on Friday, um, and then this goes further into the month. But yeah, this week, just got FOMC minutes and Powell speaking. We have a little bit of other things, in detail, but the big things right here. We got the next rest of the month coming in, but we'll touch on that as we go, and depending on how we decide to kind of do these webinars. But that's that. Next, I want to touch on earnings. So we have earnings. Again, earnings season is done. We know that it's funny, Zoom's here and we're on a Zoom. So we know that majority of the earnings season is done. These are smaller companies. I'm not gonna say small caps, but these are, definitely not the big names. Ones that I'm really kind of stepping out and at me is Palo Alto, right? We've got Lowe's, obviously, building construction, well, retail, material stuff. Medtronics is another one. We've traded this before. You got some of your, Chinese electric vehicle makers not really interested at all in that. Um, Not much here, Lazy Boy, unless you like furniture, but Target, Target, Macy's, and TJX, those are the big retailers, right? US-based retailers. That's going to give us an idea how they've done over the summer. We've got Snowflake, people like that. We've traded it. Not the biggest fan of it. It's mostly a growth company. We have Zoom, of course, right? One of the big, big names back during the pandemic. And hey, it's still around. We're using their product still. Definitely a shadow of its former self, from a market cap and from a powerhouse because it wasn't as big a deal. We had work from home. Obviously, people are still work from home. We have people that are hybrid, but overall, a lot of people went back to work, and maybe they're still using Zoom. So there's that. We've got Peloton, an absolute dumpster fire of a company. Um, who would have thought if you charged for a stationary bike, you put an iPad on it, and yeah, you added a subscription model on it, and you charge an arm and a leg for it, that it wouldn't sell too well. Who would have thought, right? Um, we got TD Bank, not too interested in anything else. Kava is a food chain. This thing was very overvalued. So the funny thing with Kava is it's a restaurant chain, but it's trading from a valuation and the way it trades, it's trading like it's a tech stock, like as if it's come up with a cure to hunger or something. Like it's wild, right? And that's about it. We got into it, but other than that, another restaurant chain here, Red Robin. Nothing too exciting. Nothing too popping out there. So that's earnings season for the coming week. With that said, opening up to the questions, it's quite a few of here. If you have questions, anything you want me to look at, any kind of stocks, I'd be happy to. Please type them in the chat if you want me to take a look at them. And then we will go from there. If there aren't any questions, everyone's kind of feeling good, solid. What we will do is we will wrap it up and call it a day, right? Hopefully, so far everyone's had a good weekend. Target. All right, good. Questions came in now. Target. So this has had quite a good run up. If you recall, last October, there was they were taking quite a bit of flack. They were kind of being boycotted and kind of just took a lot of heat last year, and they had a nice comeback. They pulled through. That goes to show you, like be careful, because sunny days nor stormy days last forever. And Target's had a nice run. Really for the majority of the first half of the year. And after that, it's just been kind of dropping back down. So they had decent earnings, not the greatest last time around. They have earnings coming up. Obviously, we know the earnings side is a pretty much a coin toss. But with that said, I would not personally be. looking to buy this year. I liked how it was consolidating, had moved up here, but it's right up against the 50 and 200-day moving average. Plus, we're going into earnings. That's to me, especially because it's a retail stock, that to me is like not the most confidence inspiring. All right. That's my 2 cents on it. Okay. Google and Amazon. So we'll go bring up Google first. Google, nice consolidation here after this pullback. There's been others like, you have Apple with a big recovery. Like, see that? Big recovery. You have Microsoft with a little bit of a recovery. Um, Amazon with a nice recovery. But Google, on the other hand, it's been consolidating in this and not really been a big participant in this V-shaped rally that we've seen the past week and a half, 2 weeks. Okay, so this is definitely a good setup. Definitely a good setup. I like that it's holding about the 160 um, area, consolidated a bit. If you are looking to, take a long position, I can't really fault you. It's obviously a great company. It's still a bit richly valued in my eyes. I think it's still a bit mm, not the most I would say bargain basement type of price right now from a valuation standpoint. But it's about $10 away from the 200-day moving average. The 200-day moving average, if we're about 5% drop from here to get to the 200-day moving average. So keep that in mind. I think it's a decent entry area right here. Of course, are the markets going to continue? If the markets are going to continue to go all-time highs, maybe they can get back there. Yeah, I think they should participate. Right. But if we do see a pullback, once again, we see a little bit of profit taking. We see some economic data come in, or Powell says something in a speech. Who knows, right? That can weaken Google significantly. But I think this is a better entry than, let's say, something like Apple. Like, I would not be buying Apple here again. Like, look at this. Not a single red day. And guess what? Warren Buffett disclosed like cutting his position, and he only has like 30% of what he had in Apple left. And everyone's like, "Oh, Warren Buffett sold." Well, yeah, the data is delayed. He's already sold some time back. Not all of it, but most of his shares. And guess what? Not a single red day. And this flies in the face of all the people saying, "Oh, like Warren Buffett sells, this is done, like the stock is gonna dump." And it's not as simple as that anymore. There's been times where, as we know, with Alta, like Warren Buffett, well, when I say Warren Buffett, I mean Berkshire Hathaway. When they take a stake in something, it can have a positive impact. Like, Ulta makeup brand, uh, retailer, department store, whatever, um, had a nice solid, not a 17%, but about a 15% move, 14% move, on Friday, uh, well, Thursday, and then Friday continued holding up there. And why? Because, once the 13F filing showed that Warren Buffett took a position, or Berkshire Hathaway took a position, it, had a positive impact. So it's not exactly a given when Warren Buffett, Berkshire Hathaway, or another institution sells, doesn't mean the stock is going to dump. Or when they buy, it doesn't automatically mean it's gonna go up. But in this case, it did. Another example, also, we traded this, but I got out just before the announcement. Got out here for profit. Was Bill Ackman. Bill Ackman, Pershing Square Capital, his hedge fund took a position, or not took a position, but it was disclosed um, on Wednesday that they have a position in Nike, and then Nike jumped another 4%, I believe, right? Okay, about 5% the next day, and then it continued a little bit higher, right? So, uh, yeah, these filings, there's no edge per se. Like, it's good to be aware. It's good to have an idea, right? It's good to kind of see what the big players and big shakers and movers are doing, what they're holding, what they're not. But is it a basis for an entire investment strategy? Is it a basis for entering and exit solely based on that? Hell no. No, no, no. Okay, I cannot say it any simpler. Right? Amazon, All right. This too got heavily oversold. This was weak even before we saw the pullback in the markets, right? This was already weak, and obviously it declined further. A big drop on earnings, right? Big drop, break below the 200-day moving average. Definitely got bought up. So this is a bit of a V incline too, just not nearly close to where it was at the all-time highs. But this has been bought up. I'm not a buyer here. I feel like obviously in hindsight, it was better to consider here. But after this break, if you really are looking to take it as a short-term trade, maybe see if you can run it up to 185, 183, at least this 184 50-day moving average if you are, looking at it from a momentum technical trade. Otherwise, I would say that this is a bit of a overextended push already. I don't like to chase these. I like to be a little bit early, even if it means that it kind of curls over on me or consolidates. I prefer to be a little bit early. So, if I really wanted, I would have considered here, and maybe it does go lower, right? Because it's not enough strength, or maybe it consolidates sideways. But I prefer to get those kinds of entries instead of having this kind of move up here and then getting in here, right? That is very much a style difference, okay, an approach difference. I'm not saying mine is right per se, but it's definitely a difference in style and approach. Okay. We have another question. NVIDIA, this is obviously the big name of the past year. Massive run up. Uh, massive run up. Also moves big, obviously. This has also participated in the drop, but also a V-shaped recovery. Approximately 12% from all-time highs, right? It's still worth 3 trillion now. Like, we went from less than a trillion to 1 to 2 to 3 trillion market cap so fast. I can't stress to you how fast this is one of the largest, like fastest uh trillion-dollar market cap growers ever. Okay. Some of it is justified, most of it isn't. Okay. Yes, their revenues have been amazing, their profits have been amazing, but it's all booked front end. So when people in these companies, whether it's Meta, whether it's Tesla, whether it's, all these other companies, especially when it comes to the AI boom, anytime they're buying their NVIDIA's products, they're not buying them and then they're gonna recycle them and then repurchase them every year. It's not an iPhone thing. They're buying them, the servers and the GPUs and all the infrastructure with a long-term usability scope, right? And yeah, it's technology, so it's going to be replaced a little bit faster or quicker than, let's say, some other heavy equipment. But there is longevity in there. So what NVIDIA has done is it's front booked its revenues. They've done a massive push, right time, right place, great products, obviously. So it's front booked. Is Meta gonna keep buying, a few billion of, servers and processors and GPUs and all that from NVIDIA? No, it's gonna either stop or hold off or just pause and just slow down. Same with Tesla or whoever else, everyone else that's buying. So what they've done is essentially, this is why we call semiconductors cyclical. They don't have a steady stream uh like some other industries, right? Like retail usually has a steady stream and then they have a good few couple months, in the holiday months. But they're pretty steady the rest of the year. Pharmaceuticals, big large pharmas, they don't have like, all right, everyone's gonna get their diabetes medication in Q4 and then no one's getting it in the rest of the quarters. No, people are buying these things steady, right? That's why we don't call them um, cyclical. But semiconductor companies and Nvidia on the retail side, remember Nvidia is on the retail, so not a retail, but like the they're not in the manufacturing side. They're not in the production side of it. That's TSM. All right, and either way, great company, but far too richly valued. Okay, if you would have traded this based on technicals and momentum, you would have done well. If you were trying to trade this based on fundamentals or have some margin of safety, you would have stayed out. And we've made some money shorting this. We've made some money maybe taking a long here and there for short term, but other than that, we have not been one of those, um, or at least I haven't been one of those types of traders where I've just bought and hold this thing. In hindsight, yeah, sure, but it is not suitable to me to do that because there's been plenty of companies buy and hold that haven't worked out, right? Just look back from 2020 to 2024. See some of the companies that were going crazy. If I have to pick on Zoom again, right? Like, oh my God, it makes me laugh. Just makes me cringe, actually. Yeah. Again, just one example, right? Like, I hate it when people cherry pick just winners and then they realize like, holy shit, there's worked out this time, but had they had that philosophy for other companies, like Zoom is the future, everyone's going to work from home, right? All things that made sense. Like, yeah, everyone's going to work from home, and they did for a certain period, and everyone's going to be using Zoom because it's the best and biggest, and uh, forget 2020, right? Forget 2020 and 2021. Let's just go here, right? 2021, getting into the end of 2021. Just go there. That's a drop of 85%. You know, there's a reason why I take a margin of safety and more of a conservative approach to my positions. Okay, so Nvidia, I'm not a buyer here. In short, I'm not a buyer. I'm not shorting it off the gate yet, but this area is definitely key 125. Um, Again, market dependent. We know that this moves big, right? These candles may not seem like much, but they're multi-percent movers, and obviously they've had a split, right? But this is crazy. This was like, a $1,200, $1,300 stock, and it would still move, 4 or 5% a day, right? So it still moves big. Keep that in mind, from a percentage standpoint. Okay. How do I feel about, upcoming rate cuts? So Omega, or sorry, Realty Income Corp. I don't know why I thought Omega, but this is another great company. We've traded it, we've held it. It's a solid REIT. It's one of the more famous ones because they pay a dividend monthly. It doesn't really matter whether they pay monthly or not. What we care about is the dividend yield, right? And they have a dividend yield right now of 5.14% right now. So this is looking good. You can see from July onwards, it moved up. The earnings weren't the greatest, but you can't just look at earnings for REITs like this because they operate a little bit differently, right? They have to pay out a large portion of their income to um, investors just based on the REIT structure. Um, it's a pass-through entity. Anyways, point is, they moved up, as you could see, as data came in, the Fed and Powell and the gang were talking more, maybe cut, maybe cut, maybe cut, maybe we will do August, maybe we'll do September. As that kind of narrative built, you can see this thing continue to move up. So it's a great company, good company. Obviously, we never want to buy solely based on a dividend yield. That's literally asking to get slaughtered at some point. We just don't know when the guillotine is dropping. So I don't solely chase a yield. It is a good company, not a bad price to consider an entry, but this is not ideal for trading, so to speak. Can you trade it? Yeah, like swing trade it, but to consider for a hold, long-term hold, more maybe like in a retirement account or tax sheltered account. Okay. Will it see 70 anytime soon? That's a bit of a reach. Honestly, like we know REITs move small in the sense that they're lower beta, they have large percent of moves. 70 is a bit of a reach. It's a 16% move, 17%, let's say. It can it reach that? Yeah, it can reach that. But in what time? Only God knows. Okay. Um, Tom is saying shitting on Zoom while we're using it. Love it. Yeah, yeah. I mean, I always say, like, for example, I like certain products. I like certain brands. Like not really, but like any brand I like, cars specifically. Like if I like certain car brands or products, or I like certain things, I am never going to just be a fanboy or a diehard just because I like it or use it. So like I like Apple products. I use iPhones. I only use iPhone. I've never used or had an Android phone or a Google phone or a Samsung, right? Does it mean they're not good? No, I just prefer Apple products. But I'm also not such a diehard where I'm going to be like, Apple is the best. Apple releases a little paperclip that's $2,000 and it's the best decision. No, fuck that. If it's stupid or if it's overpriced or if it's like, nonsensical or if it's like late to the party, I will call them out on that, right? I will call it how I see it. And that's my motto. I will call it how I see it. And to me, it's in this case, Zoom obviously was kind of clear to see that, boy, it was overdone. And we shorted it a bit here and there. I remember um, it was wild, wild times. Jazz is asking Crowd. So Crowd has made a nice recovery. Obviously, nowhere near the recovery it needs to get back to forget all-time highs, even getting back to, you know, where it was before the outage, 337. It's been massively oversold. I think it's like butchered. It was butchered. It's a growth stock, obviously. Um, so we know, the fundamentals there are a bit not the most ideal if you're just going to try trade solely based on fundamentals, but we know like it's got another 30% just to come back to where pre-outage. Okay. With that said, the drop from all-time highs was like absurd, like 50% in a month, 20 trading days. That is wow. That's not common, guys. That's not common, even for tech stocks in this fast moving market. So we didn't quite catch the bottom, but we are still in the red on this holding it. Definitely not as red as we were before, earlier, a week or two ago, but I'm carrying it. I think it does have upside. For me, I have a target of like 280, 290. And you'll see that comes right near just a little bit below the 200-day moving average, right? So uh, I'm continuing to carry it. We do have earnings coming up on it, not this week, but the week after that. So a bit of a hairy situation, but I am carrying, okay, for full transparency, all right? Of course, that does not mean that it's going to get to my target or can't curl back over or that you should hold it as well, right? But awesome, great question, great session. Appreciate everyone getting on. Appreciate the support. Hopefully you enjoyed it. I know it may not be as suave and fantastic and amazing as when Chris is running it, but you know what? If I've learned anything the past year and I would say that pretty much all my life. It's that nothing is constant. Uh, the only constant in the world is change. Okay, better or worse. Some things we have control over, some things we don't, right? So we continue on. With that said, thanks everyone. Have a great rest of the weekend.